Hey everybody, for those who don't know me, my name is Paul Brands. I'm with People's Home Equity here in Novato, California. So, welcome to the webinar. This is my first webinar of many to come with the focus of answering the big question of with rising interest rates. By the way, if you don't know interest rates are rising, now you do. How is that going to affect the housing prices here in Marin and Sonoma County? And also we're going to talk a little bit about the surrounding areas. Now, to answer this question, I can't think of anybody better to bring in and hear his presentation on the economy, and that person is Dr. Robert Eyler. Now, Dr. Eyler is president and head of research at Economic Forensics and Analytics. He is also the dean of the School of Extended and International Education at Sonoma State University. He's professor of economics and director of the Center for Regional Economic Analysis at Sonoma State University. He's the author of 2 books, and of course, he's a professional speaker. So if you're interested in having your company reach out to him, have him speak, check out, there's his email right there. Reach out to him. He's an absolutely wonderful guy, very knowledgeable, and he's sure to impress. So with that, you guys, enjoy Dr. Robert Eyler.
Okay. Well, welcome to this webinar about interest rates and housing. My name is Robert Eyler. I'm the president of Economic Forensics and Analytics and a professor of economics at Sonoma State University. You can see my contact information there on the first slide. So let me know if you have any questions about this webinar or anything to do with what's going on regionally in terms of our economics. I want to start by talking about some national and global themes here this year. Obviously, our president has had a lot of action both in the media and in Congress with a new tax bill right at the end of 2017 and also with a new omnibus bill package that came through in terms of spending to keep the federal government moving forward probably through the end of the federal fiscal year in September 30. So we're watching very closely as economists of what new stuff may come to pass in terms of more spending and other policies that the Trump White House tries to get through before the midterm elections in November. We're watching equities markets and seeing how investors remain confident or non-confident in the greater macroeconomy, also thinking more globally. We will see what happens with investor confidence. We saw a little bit of a wiggle, which we'll see a graph of in just a second at the beginning of this year. And whether or not the tax package and the new spending make investors more or less confident is anybody's guess. We will see how the rest of the year goes. And now we have a lot of trade concerns. So China has now become a target of the Trump White House in terms of ostensibly protectionist policies. China's talking about doing some tit-for-tat policies in terms of being protectionist themselves. And a global trade war is one of the things that economists right before the election in 2016 were most concerned about in terms of what an economist would call truncating the business cycle and making the current run shorter and causing recession to come earlier than we thought would happen otherwise. So in terms of what to expect in housing markets and sort of, let's say, in capital markets that are involved in housing, I'm going to talk mainly about 5 major items. One is the slow growth of units that have been built. Since the recession, we've seen a real slowdown in the trend of single-family homes. We have not seen as much of a slowdown in multifamily, but multifamily generally is for rent and not for purchase. And in most of those cases are going to be in urban areas. Second piece is rising interest rates. Now, after this long of a run in terms of the macroeconomy, we should expect higher interest rates. And as a result of that, a lot of people are concerned in the equities markets that those rising rates are going to undermine profitability and there's going to be a sell-off, which will then have ripple effects into housing. The next one is going to talk a little bit about the continued internal and external demand for housing and look at some price data to try to figure out whether or not there's latent demand sitting around specifically in the North Bay, Marin, Sonoma, and Napa counties, but also thinking more about how rental and housing for purchase kind of work together historically or should, and why we may be in a little bit of a change now because of the lack of new housing. We'll talk a little bit also about the fires and the rebuilding piece, and whether or not the Bay Area remains as a driver of just Marin County real estate, but really of the entire Bay Area or the entire North Bay. At the national level, this is what the growth of new units looks like. You can see the single-family trend after a long ride up from basically year 2001 on up to peak sometime early 2007, drop precipitously, and you can see the shaded area between 2008 and 2009 is the most recent recession, and then we've seen this very slow sort of gradient after 2011 rising up as single-family home building increased nationally, But you can see a real movement back up, almost like a V-shaped recovery in multifamily units. But again, most of those were going to be in rental and in metropolitan areas and not in our suburban areas. And we've even seen maybe the peak of this cycle in that too. As you can see, the blue line is starting to top off if you were to draw a trend through that, and maybe start to sag back a little bit as single-family homes pick up. This is another way of looking at that. You can see the blue line on this graph, which is focused primarily on the single-family housing market. The blue line is the pricing. You can see, again, the sort of V-shape in pricing where we saw a peak, a drop, a rebound, a little bit of market sifting, and then basically trend up. You can see in the red line the monthly supply. So one of the biggest concerns in the housing market since the recession has been the sort of small amount of new supply coming online. And as people have gone back into housing after the recession bottomed out and prices fell, attracting people back to buying homes, the monthly supply has not kept up with demand, and that supply has been slowly slipping and continues to be very, very low, historically speaking. That so-called normal range, the shaded area, is where it should be. But we haven't seen much touching that, as you can see, since basically 2012. Most of the months in between 2012 and 2018 have been under that so-called normal range, historically speaking. So two things going on. One is we have very small amount nationally, and we'll come back to this a little bit in terms of the regional building, which means the supply side is contracted, which means prices have had a lot of good support from the bottom pushing up. The problem is if you're trying to buy a home and you're renting right now, it's been a pretty tough market. So some general quick takes. Rates are going up, and to a certain extent, economists agree that they're going up for the right reasons. We don't like rates going up because of unexpected inflation, or let's say unexpected risks and shocks in the capital markets and in the general economy being reflected in those that are providing credit, asking for higher rates of interest. But we still should expect some increase. The key is it is predictable and slow moving. If there's any sort of upset in that, or there's more volatility than we expected, that can be a problem. We think housing will be affected at some point. And another thing about rates, because they were so low for so long, there's actually sort of an inflection point as rates go up. So housing markets may not be affected as rates start to go up in earnest. It'll be at some point as it's rising that you'll see a twist in the market and people will slow down their demand for housing. One of the things funny about that from my angle is that in the North Bay, we haven't seen a lot of people leaving. We've seen a lot of people coming, even as housing prices have gone up. So while the interest rate being low certainly attracts people to housing, the price to get in has still been rising. So people still been buying, and it makes you kind of scratch your head and wonder, maybe it's because people don't want to leave this area or are attracted to this area for other reasons, where the interest rate is never going to go high enough to really push away the market in earnest or in full. One of the things about the market since the recession has been this mix of using adjustable rate mortgages and fixed rate mortgages. And one thing I'll just tease about a little bit is that the 30-year conventional fixed loan might be on borrowed time. We will see. But certainly if you're using an ARM, you've got to be a good financial planner and think about how it affects your wealth over a long period of time. This is one of the biggest issues that happened before the recession and maybe caused some of the recessionary activity, is when interest rates went up. There was a quick move to the tipping point where people basically walked away from their adjustable rate mortgages, and that caused a lot of chaos in our capital markets. The ARMs are still out there, and if you're using them, it's a good time to be using them because rates have been so low. But you got to be a good planner in terms of using those kind of instruments. Regional markets, generally speaking, unfortunately, because of the fires exacerbating the supply issue, look good from a pricing standpoint, but the fires are going to lead to some very strange movements on the supply side. We don't know how many houses will be rebuilt. We don't know if we'll end up with a little bit less, a little bit more, a lot less. But just because that sifting might take 3 or 4 years, between the national macroeconomy, interest rates moving slow but steady and predictably up, and housing markets starting in a pretty good place, economists right now are not expecting any downturn in housing prices through at least 2020. So if you're in a home right now, things are looking pretty good. One of the things that has truncated the business cycle, as I alluded to right off the top, is the fiscal packages that have come forward in the last 6 months, starting with the tax bill at the end of 2017 and then the large spending bill that's now come in March. Those things are going to cause more debt load for the American economy and potentially more pressure on bond markets, which then affect mortgage rates and might spill over into housing. So those the evolution of 10-year treasuries are going to be one of the biggest concerns for financial markets going forward the next 18, 24 months, and how the Trump administration spends money with respect to both A, having lower tax revenues, and B, having a large spending package that needs to be financed going forward. We will see how that affects the demand for housing loans and the rates that people are paying on new loans. Let's talk about rising interest rates for a little while. So rates move because the supply and demand for credit is on the move. And so what we've seen is rates slowly rising because demand is outpacing supply. I'm going to show you a graph that actually is a little bit of a twist on that based on regulatory environments. But generally speaking, we should expect rates to be moving because the supply is lower than the demand for credit in the current marketplace. It doesn't force all rates to change when the Fed moves rates. And this is something that's a very important point, just sort of Econ 101. Is that when the Federal Reserve is changing rates, or you hear that the so-called Federal Open Market Committee changes the interest rates for the United States economy, they're changing the overnight bank lending rate that happens between banks. But because of the opportunity costs inside of capital markets, that changes up a lot of the upstream interest rates, demand and supply characteristics, such that other rates will tend to want to move in the same direction as the Federal Reserve change. However, the farther you get out on the yield curve, and we'll see the yield curve in just a minute, or the so-called relationship between the long interest rates and the short interest rates in bond markets, that curve can flatten if the central bank increases short rates too quickly or unpredictably, because the long end of the market is not reacting at the same speed. And that flattening of the yield curve, as I'll allude to in a minute, has been a very good predictor of recession when it's gotten flatter and flatter. Now, one of the other rates that runs around the world is called the LIBOR rate. That LIBOR rate is something that adjustable rate mortgages usually are based on. And as we'll see in a minute, the LIBOR rate has been slowly creeping up, and it's set to sunset in the early 2020s. And when that happens, we'll have to see adjustable rate mortgages at banks will have to use a different rate of interest to set the rate at which the rate will move in the adjustable manner. But we'll see that the one-year Treasury security in the United States and the LIBOR move very, very much in sync with each other historically, and that's likely going to be, with some premium, what banks will use to mock what the LIBOR would have done otherwise. The professional forecasters in the United States economy believe that we're seeing a bit of a boost. And so if you look at this graph, the left-hand column of each one of these three variables is the old forecast in quarter four 2017, and the new forecast is in the second column as of quarter one 2018. And you can see in the real GDP percentage growth category, all the forecasts for 2018's quarters are up from the previous forecast, and a lot of that was based on what professional forecasters believe would happen in the American economy based on the new tax law. But you can see now in the second panel of this table that the annual growth rate is up for 2018, up for 2019, but then the up for 2020 is much smaller, and the growth rate is shrinking in each year. Most economists believe that the tax bill, because it's really focused at a time on spending when we really don't need that big a boost in the economy, will actually have more detrimental effects in the medium term in terms of sparking more inflation and more of a slowdown in the economy than it actually will have as a boost due to spending. We will see if that plays out, but this forecast is reflective of that perspective. The unemployment rate's sort of swimming around 4% at the national level, and these data are for the national level economy. You can see that really we're not deviating from that on the annual side anytime soon, which means that basically economists believe that are doing forecasting for the American economy that the supply and demand characteristics for labor are going to be pretty stable for the next few years. Not going to see a surge in supply, nor really that huge a surge in demand. And payroll employment is basically going to be around 155 to 180,000 new jobs per month per quarter. So that's what we're looking at as far as the forecast going forward, which is a good forecast. It's not a bad one. You notice that there's no recession in sight, maybe even through 2021. And I'm showing you these shaded areas to remind you of the main spots I talked about. So now let's look at prices. One of the things we're concerned about in terms of inflation is tracking it, because that tracking of the prices tells us something about what the Federal Reserve may or may not do. That core goods CPI is basically the consumer price index for goods, not services. The services is that red line above. And you can see it's been trending down. So that strips out food and energy products. And it's been on this sort of slow downward trend for some time. But services have sort of picked up with respect to inflation. And so the total core CPI, or the consumer price index without food and energy prices, is that middle line, which kind of almost wheat colored, if you will, And that line going above 2% for, let's say, 2 or 3 quarters in a row is normally a trigger for an interest rate increase at the Federal Reserve. So economists have been using this graph to sort of track what they think will happen at the Federal Reserve in the subsequent month or quarter based on the last 2 or 3 quarters of price data. Another little point here is that downward arrow may be because at the end of the day, the consumer price index on goods is getting lower because the actual movement of those goods to market is getting less expensive, with businesses like Amazon providing lower cost shipping and lower cost logistics for people to actually get it direct to consumer. We will see if that continues over time. And you can see there's that shaded area with that 2% marker around the so-called total core CPI. Here's equities markets, and I'm going to show you two shaded areas on this graph. This is basically from 2008 to 2018, so about a 10-year stretch. And you can see it bottomed out on March 9, 2009. This is the S&P 500 and has been on this sort of long-term trend upward ever since, even though there's been some wiggles in the middle. You can see that the shaded area at the right-hand side of the graph, which basically is right after the election, you'll see that so-called Trump bump that happened after a little bit of a downturn in the summer and early fall of 2016. We saw a kick up after Trump was elected, and we've been riding that crest all the way to January 2018, and then we had a big slip at the beginning of this year, and we've kind of been flat ever since that slip. But even with that very quick downward movement earlier this year, trend-wise, you can see on this graph, it's obvious that if you bought an S&P index fund in even 2010 or 11, you've made some serious gains since then in your equity portfolio. So two things about this. One is this is a sign that wealth has been somewhat recovered in the American economy. It's also a sign that at some point this movement has got to end. And when that ends, you're going to see some profit taking, and there's going to be a little bit more chaos in equities markets. So we'll see if the things I've already talked about don't cause more volatility in this market over time. One of the graphs I alluded to earlier when I talked about monetary policy was this graph that's about excess reserves. So these areas that just got circled are, just missed that one. These areas that are circled are sort of 2 points to think about in terms of the so-called excess reserves. This is cash on the sidelines that banks hold at the Federal Reserve, that could be lent out but have not yet found a home. The one on the left-hand side is $22 billion in 2008 dollars, and that $22 billion is what happened right after 9/11, when banking basically seized up for 3 weeks and not a lot of lending happened at all, and really not a lot happened in the American economy for 3 to 6 weeks. But when we got back on track, notice there's a lot of sort of blue pockmark data along that zero line because A, we got right back on historic trend, but B, after September 2008, we saw this amazing increase in the amount of cash sitting in vaults waiting to be lent out that's still in many cases have not found a home, and we're now at 1.85 trillion in cash. So if you think about right after 9/11, a lot of economists were very, very concerned that banks were going to stop lending. We're going to be very, very cautious about the world financial markets, and we cleaned a lot of that up relatively quickly. But since the recession happened, banks, not only because they're concerned about risk-taking in financial markets, but furthermore, regulatory environments have asked banks to hold more liquidity. You're seeing some of that liquidity held longer term. I mean, that's a long stretch of time we're looking at from September 2008, now almost 10 years, where the amount of cash sitting on the sidelines really has not, since 2012, been under 1.6 trillion in cash. So that cash sitting on the sidelines has done two things. One is it's slowed down growth in our economy. Economies usually recover due to capital markets providing financing and spreading that risk beyond the household or the business onto financial markets. So having that much cash sitting around not lent is something that has probably given us lower growth rates. But the second thing is also latent inflation. If all this had come to fruit simultaneously and we saw this 1.85 trillion go back down to something that's more like 1 or 2 billion in real terms, which is the historic trend before 2008, we would probably have a lot more inflation pressure on our economy because that would have become spending somewhere. So economists have watched this graph for two reasons. One is that it's really a reflection of the mix of a lack of risk-taking and the new regulatory environment for banking. But it's also kind of a fascinating graph because it deviates so far from long-term trend since the most recent recession and has not really shown any signs truly of going back there, that it's one of the very few graphs economists can look at and say we've really had almost like a structural break in this data point, and economists are very invigorated when these kind of things happen. It turns into hundreds and thousands of pages of scholarly articles when this happens. So here's another graph I alluded to earlier, which is the yield curve. This is basically the I'm not sorry, this is not the yield curve. I apologize. This is the expected federal funds rate. This is the expectation of where federal funds rates are going over the next few years. And you can see that even just this year, there's been a lot of volatility in the first 3 months. We've gone up the ladder a little bit more as we've seen more rate increases. And the one here that you see is the latest one, which is March 13. That will now shift up in the next iteration because we saw a rate change a couple weeks ago. But the bottom line is we expect the interest rate to go up at the Federal Reserve, and this is that rate that the Federal Reserve sets. So the upward movement suggests that we're going nowhere but up over the next couple of years, which is good. The key is that this curve is increasing with a decreasing rate. And notice that it has that sort of characteristic, which means it's looking to peak 3 or 4 years out, not continue to rise faster and faster. Another graph that also kind of corroborates what we just saw is a so-called dot graph. These are the actual voting members of the Federal Open Market Committee at the Federal Reserve, and the Federal Reserve Bank of Cleveland tracks what happens in the minutes of those meetings to get a gauge of where those members think rates are going. So you can see in 2017, they're sort of coalescing around the idea that there's going to be more rate increases. And then for 2018, we saw this creep up, and we're expecting maybe even we might see 3 or 4 rate increases and be right around 2% on the short-term rates by the end of the year, and then up the ladder we go. So before the end of the year, 2017, that was the trajectory of these rates. And then since the tax bill was passed, this has become the trajectory of the rates. Whoop, now it looks like I screwed that up. That's become the trajectory of the rates. So just that the tax bill passing forced the Federal Reserve to reconsider the movement of inflation, the movement of interest rates, and actually structurally change their original forecast for what they were going to need to do to provide some stability to inflation. But the cool thing is in the longer term, we expect those rates to moderate a little bit. And most of the folks that sit on that Federal Open Market Committee believe that in the longer run, we will see rates on the short end really not peak much more than 3%. Now, the prime rate that businesses get currently is 3.25% above that rate. So if you think of that rate being 3% and then the prime rate being 6.25% maybe as a general average peak, that historically is still a really good rate for the best business customers of banks to get. And that sort of suggests that housing markets are going to see a relatively good time going into the so-called longer run, at least past 2020 for the time being. This is something that really is a reflection of the yield curve, and that is the spread between the 10-year Treasury note and the 3-month T-bill. The 3-month T-bill is very correlated with what the Federal Reserve does, and even the 10-year Treasury note is, in fact, also very correlated. But I have 2 red arrows on here to point out 2 specific spots to watch for. The first one on the left-hand side was when the spread between these two dipped below 1.5. And why that's significant is because since 2008, it had not got there since the recession. So that was something that sort of was giving economists pause and saying, wow, we might now be slowly moving toward the point where that spread is getting smaller and smaller. Or another way of seeing that, as this graph creeps closer to zero, it means the so-called yield curve, or the difference between long-term and short-term rates, is getting flatter. You'll see that we've hit another bottom here, and in fact have been sort of rambling around just north of 1.25% and just under 1.25% for the last 18 months. That once we hit that spot, even though we went back up for a little while, we came back. The trend has been slowly to slip and slip, and this is classic in a positive business cycle. As the economy grows, you should expect this flattening to take place, because short-term rates short-term rates are going to rise a little faster than the long end of the bond market. Now, here's the kicker, that a lot of economists have argued about how predictive this kind of graph is in terms of recession. The 10-year T-note, which is the next graph I want to show you, the spread here in the longer term is the next graph. So while the 10-year Treasury is sort of the key interest rate, this spread is on this graph. And the spread here, when it goes below zero, has predicted recession 9 out of the last 10 recessions within a 6 to 24 month time frame after going below zero. So another way of thinking about that is when the yield curve actually goes flat, when long-term rates are basically the same rate as short-term rates, it's between 6 and 24 months later, 90% of the time since the Second World War, that the United States economy has gone into recession. So that's something to watch for very closely, and why economists are very focused on the spread here is because it has had a relatively high prediction rate of recession within six months to 2 years. So watch that closely. All the data I'm showing you here, by the way, is available publicly, and the sources are at the bottom of each slide. This is the LIBOR and the one-year Treasury. So as I talked about before, one of the things I was asked to discuss was what happens if the LIBOR sunsets, or when it sunsets, and what happens to adjustable rate mortgages. It's highly likely that what will happen is that banks will adopt something that looks like a one-year Treasury rate plus a premium. And historically speaking, since 1970, the LIBOR and the one-year Treasury have deviated on average by about 50 basis points. So whether there's been bigger or smaller spreads is kind of immaterial. At the end of the day, since banks are more concerned about the long-term relationship, thinking that the one-year Treasury plus 50 basis points will likely be the candidate that banks will use to price adjustable rate mortgages is something to watch for as a way of thinking about something that people can easily relate to on the bond market, and what will basically be the LIBOR in its next iteration. Let's now quickly talk about and shift our focus away from interest rates and start talking about housing more specifically and thinking about purchasing and renting in this area. So in the North Bay, one of the things that has been tricky to watch is what's going to happen with internal and external demand. And there's an old saying in real estate, and some of you veterans of real estate might think I'm an idiot for saying it this way, but that there's a buy to rent ratio that when it hits 1, we've got trouble. I'm not going to talk about that, but certainly it's the case that we've seen rental prices and housing prices basically walk hand in hand in this recovery period. And a lot of that's not because of demand as much as it is because supply has been relatively restricted. I think there's a lot of people in rentals who would buy if the inventory allowed them to do so. So let's look real quickly at the growth of housing prices. This is Marin County, Napa County, Solano County, Sonoma County, Contra Costa County, and San Francisco all at once. So if we look at this graph, notice that there's really a premium that exists between Solano County and then the mix of Napa, Sonoma, and Contra Costa. And then there's a big jump when we get to Marin and San Francisco counties. And this is a graph that starts in 1996 all the way through February 2018. Those premia have existed in the long term, and that's because our labor markets work in such a way that people are basically living in specific areas and then accessing core Bay Area labor markets. So notice that, and this is, I think, true in anecdote, Napa County, Sonoma County, and Contra Costa County are seen where people live and then come in to work in the Bay Area. Marin County also has that characteristic, but because the demand to live in Marin County has been relatively large and we have relatively restrictive policies in Marin County around the use of land, units have been very slow to move. Marin County has pumped itself up in pricing almost like a district of San Francisco. In San Francisco, the core county and city have really outpaced everybody long term, specifically since the recession ended. But notice that Marin County pricing was above San Francisco for a long period of time along this time series. And a lot of that was because people ultimately were willing to pay a premium to leave the city for a more diverse housing market in Marin County, still remain very close, but in a place that politically and aesthetically felt a lot like San Francisco. This is rental pricing in contrast, so I'm going to walk you through this nice and easy. Here's Marin County rental prices in real terms, and I don't say this here, but this is in 2009 dollars. You can see that it's been slowly going up since 2010 and is now somewhere around $3,300 a month to rent a 2-bedroom home apartment here in Marin County on average. San Francisco is much higher than that, and there's a premium to live in San Francisco, which makes a lot of sense. Alameda County has basically tracked the same trend as Marin, but it's a little less because Alameda County is a larger place, a little more diversity in its rental market, and Sonoma County is lower than that. Larger than Marin County, more diversity, but less of a premium to live in Sonoma County versus Marin. This is a suggestion since all these are rising as well, and vacancy rates are below 5%. In most places, they're below 2% or even 1% of viable housing stock. We have a very, very tight housing market at the same time we have a very, very tight labor market. And what that means is that even if we saw a downturn in pricing of homes by maybe 10 or 15%, it wouldn't last very long, assuming that renters want to become homeowners in the same place that they rent. And if all that happens well, then folks will see more of a rental contraction than we'll see a home price contraction if we see some recessionary activity. Another thing to think about, and I want to show this graph here, is that as of February 2018, Marin County is now the fourth highest pricing county in the United States. And Manhattan Island is by far the most expensive, but San Francisco's been creeping up on Manhattan Island. San Mateo County is right below that, so there's a big drop off after San Francisco, and then you get to Marin County. So this is a price per square foot that people are paying for housing. And the reason I say it should provide you with some pause is because notice that the 3 of the 4 top counties in the United States are adjacent to each other, more or less: San Francisco, San Mateo, and Marin counties. And the difference between obviously San Mateo and San Francisco is relatively large, but the difference between San Mateo and Marin County is not that big, and it's because basically San Mateo and Marin County are looked at as extensions of the core Bay Area as where to live and work. So Marin County being that high, if you think about the dynamics of San Mateo County, San Francisco County, and Manhattan Island in terms of real estate, we might be entering a phase where Marin County specifically, not so much maybe Napa and Sonoma counties, but Marin County may be getting to a point where housing prices here are not going to dip for a very long time, or with, let's say, significant percentage change, perhaps in most of our lifetimes. So we will see about that. Let's talk about the fires, because the fires have had a wild impact, obviously, on our regional belief that we are safe here from anything but an earthquake. And it's certainly contracted the housing supply. What I want to show you is sort of the summary. In one of my jobs as a professor at Sonoma State University, our economics department actually started to put some data together about what's been happening in the wake of the fires. And so between Napa, Sonoma, Lake, and Mendocino counties, about 9,000 homes, 9,000 buildings were destroyed, and about 6,400 of those were homes. But another 500 homes were damaged. There's about another 3,200 buildings that were commercial buildings that were affected. But that contraction of those housing units in Sonoma County is a little over 5,000 specifically. That has changed not only the labor market and the housing market in Sonoma County, but folks that worked in Marin County living in Sonoma County were also displaced. So in Marin County, we've seen a couple things. We've seen wages slowly creep up over the last 6 months, and we've seen housing prices get a nice bump if you own over the last 6 months, because we've seen some out-migration from Sonoma County of people who could afford to come to Marin County and buy existing units to come in and eat those up, which has put more upward pressure on prices in Marin County. A little bit has happened in the greater Bay Area and also in Sonoma and Napa counties as well for whatever available units there were. But for at least the next 18 to 24 months, we may have support not only from the macroeconomy side, but also from the regional economy side in kind of a dubious way, because the fires have reduced the available housing stock even more. So in thinking about the future, some things I'm going to want to leave you with, that rates, are certainly going to rise toward the next recession, but maybe not over 6 or 7% at the 30-year mortgage rate. So if you think about what that looks like historically, it might also give you pause on the positive side, because if we're not going to go above 7%, let's say, that's historically really good for what you circumvent and lose when you rent. So as long as the mortgage interest deduction does not completely go away in California or in the United States, 7% is still a pretty good pre-tax rate to pay for lending capital if you're trying to get into a home and you're looking to buy and hold. One of the hot spots that we think might creep up is Solano County, maybe specifically Vallejo, because Vallejo has a ferry access to the core Bay Area labor markets and is also kind of at the crossroads of major arteries. We will see. Vallejo is a very intriguing real estate market because it has a wild mix of housing, of access to other housing markets, and we will see. But Vallejo certainly is a place that we see on the rise, and they put a lot of money into economic development, workforce development, and really reinventing itself as a city. So we'll see that proximity to San Francisco due to the ferry being there has helped a lot, specifically closer to the coast in Vallejo. Through 2020, don't see much change in terms of the trajectory of housing prices or interest rates. We're going to see a rise probably in both. And then at some point, interest rates will likely increase in such a way that it twists the demand for housing away from housing. But in a region where there's not a lot of rental stock available, it's all going to boil down to how much housing supply we add to the stock. And if we add very little, we might have another good run in us, even if interest rates start to rise nationally, even beyond 2020. Certainly through 2025, if you think more in the longer run or the tipping of the longer run, 2025 might be a key year. It'll be the last year of the current tax bill, and it'll sunset after that. We're likely to have some recession between now and then. At least history suggests that we'll have something. It's unlikely we're going to go on a 16-year slow but steady increase in the economy year on year on year without some recessionary activity. But the housing prices are ultimately going to be a function of supply and demand. So even with a recession, which most economists believe if and when it comes, it'll be relatively mild. And I shouldn't say if, when it comes, it'll be mild because we've had such a mild business cycle upward. Housing prices regionally here may be supported not only because people are going to want to live here and there's high rental occupancy that will come in and eat up those units as people leave and take profits off the table. We'll probably see an inflow in of people as well, such that no matter what way you look at it, this area, generally speaking, might be supported for a long time to come as a buy and hold strategy. Because we've been on this long run for so long, and certainly in the last few years, we've seen some good trajectory in housing prices. A lot of people have asked me whether or not we're facing a housing bubble. There are no current debt market indicators or even equity market indicators suggesting we're on the precipice of a housing market bubble. There's been a lot of questions about an equity market bubble. But to a certain extent, the downturn at the beginning of this year helped, I think, slow down the trajectory of equities a little bit. And if equities are relatively flat this year or even negative, which there was some prediction that was going to happen in financial markets, it's very possible that we will see some of that talk about an equity market bubble also subside because it won't be as front of mind given the growth rates of the equity markets. But on the housing market side, there are no current indicators that we're on the precipice of any kind of a housing market bubble, short of the idea that at some point, if people are truly stacking on top of each other or adding multiple households to one housing unit, which our statisticians don't like to think about, we don't track that idea very well, we may have some burst simply because the ability to afford the rising housing price won't be feasible with how many people you can truly stack into one housing unit. And we're watching that very closely. So with that, that's what I have. Thank you so much for listening. And please see my contact information again and let me know if you have any questions. Thank you.
All right, you guys, there you guys have it. Hope you guys enjoyed the first webinar of many to come. Keep in mind a couple things here. I just want to take a moment and thank Dr. Robert Eyler for taking the time out of his day to talk to us about the topic that's on everyone's mind, how interest rates are going to affect the market in Marin and Sonoma County. Also, if you guys have questions, or more importantly, if you want to reach out to him about speaking engagements, his email is right there. Reach out to him. He's a fantastic guy. Also, do me a favor. Let me know how you guys like this event. Send me an email, leave a comment, and I'll let you guys know when our next one is. So until then, hope you guys have a great day, and I look forward to talking to you guys soon. Take care.